let's have a look at learning objective number one. Learning objective number one looks at the accounting information system and describes the purpose of an accounting information system. And the purpose basically is to capture accounting information to produce financial reports which are useful for our decision making. Now, there's a range of different information systems out there, including information systems that athletes use to record their times to look at how they're performing relative over time. Car manufacturers use information systems to track how well their cars are performing against the competition. So for example, if we look at the Nürburgring, which is a famous public racetrack in Germany, car manufacturers benchmark the performance of their vehicles against competing vehicles' lap times on this track. So we can see the number one fastest road legal car is a Lamborghini Aventador SVJ that did the Nürburgring lap in 6 minutes and 45 seconds, which is extremely fast and better than everything else, which is also extremely fast in this list. And that's one way we could describe the success of a product. Now, what we're interested in this subject is the success of a business and the position of a business, and that's what we're going to concentrate on today. So the accounting information system basically identifies different activities, records the transactions and entries in the accounting system related to these activities, summarizes those activities and transactions, so essentially brings all that information together so we can then communicate that information through a series of financial statements. Now, accounting information systems vary widely, right? They vary from very manual systems, so pencil and paper systems, to some highly complex and highly automated electronic systems. So a question for you is, has anyone ever used some sort of accounting software? And what sort of software is this? Okay, so some of you may have used accounting software. And if you've worked in a small business, maybe you've used Xero or MYOB. And basically, these are software packages that allow businesses to filter through all their accounting information into a software package, which consolidates that information and allows them to generate financial reports, as well as other reports and information that they need for compliance reasons. Larger businesses, some of them use software that's produced by SAP. SAP is a global information systems provider. So generally companies that have a global presence use SAP in some way. So if we look at IKEA, at least when this image was produced, had 316 stores in 39 countries around the world. So extremely large, with a very integrated supply chain where they are producing products in different countries around the world, exporting them to their stores around the world, where they need to stock those stores, so when a customer comes in to buy something, it's actually there, and so therefore they can make sure their sales revenue is high and they generate really good profits. So the SAP systems help them do that by consolidating information about what's happening in their businesses, and at the end of the day, producing a set of financial reports that tell us about the performance of IKEA as well as other large businesses. Now, if we go back to our slides, so some of you might have used manual systems, but many of you that have worked in businesses have probably used some sort of automated accounting information system. And you might be wondering, well, why do we bother actually learning how to record accounting transactions today when there's an automated system to actually put together that information? And that's a very good question. The reason why we actually do that is so we can better understand how that information is produced and the decision making that was behind that information. So in workshop number one, I mentioned to you, accounting is more than just adding things up, subtracting things, and multiplying things. It is about making decisions about how to produce information and then interpret that information. So we can produce different profit numbers for the one business based on different accounting decisions. And today we learn about the basic transactions from which the decision-making process as to how to record those transactions will be covered in the coming weeks, so you can better understand what is going on in order to produce and interpret the financial statements that you're going to be looking at moving ahead in your business careers. So there's several key components in the process that we look at today. The first is accounting transactions. And accounting transactions relate to economic events that affect business in some way, right? So, for example, the business has purchased an asset, sold an asset, generated revenue, incurred some sort of expense, paid cash for a particular expense. These are all economic events that are affecting the financial performance and position of a business. And we want to capture these transactions through our accounting information system. Now, in order to capture that information, we use different accounts. So these are accounts that we have set up to accumulate accounting information about the performance and position of a business. And we have a set of accounts which are called our chart of accounts, right? So these are all the accounts that are available in order to record our transactions. Now, this is an example of a chart of accounts. So here you have them listed here. So this is a relatively limited set of accounts, probably for a small business. So in the asset, you have cash, you have accounts receivable, you have supplies, equipment, etc. And it flows on for the other categories of accounts that we have here. So historically, in businesses, prior to the use of accounting information systems, they would have actually had a physical record of the different chart of accounts. So that is documentations of different economic events occurring and how that entered the system. And the chart of accounts basically provided a reference point to show what accounts were available to record these different economic events. Obviously, the vast majority of firms use an electronic accounting information system. They still need to have a chart of accounts so they can work out how to record particular transactions, but they don't have the associated paperwork and filing system, at least in a physical sense, associated with it.